Welcome to Money Conversations with KJ. KJ is a lifelong entrepreneur who's made a lot of money, lost a lot of money, and found his way back again. If you're looking for a sterile how-to, you're in the wrong place. KJ and his guests will walk you through real-life situations told by the people who live them, and they are as messy as they are inspiring. Each episode will offer lessons learned, advice on how to replicate successes and avoid pitfalls, and a new perspective to power your financial literacy. Far from a one-size-fits-all, this podcast can help you build a roadmap to your personal promised land. Milk and honey for some, whiskey and steak for others, and remind you that you're not alone on this journey.
Well, hello, everybody. Welcome back. Money Conversations with KJ. I'm your host, KJ. Well, everybody, today I have a really great surprise for you guys. I have a guest on here today that you're going to get a lot out of. Hopefully, we're going to be able to get some questions answered for some people out there. Today's gentleman his name is Kelly Crane. He is the president and CIO of Napa Valley Wealth Management. Welcome to the show, Kelly.
Thank you, Kevin.
So, Kelly, I got here, what you do here at Napa Valley. They're an integrated wealth management firm with 2 California offices. You guys are in St. Helena and Walnut Creek, which I believe is both in Northern California.
Correct, yes.
And then with more than $260 million under assets, 35 years of experience, you guys integrate wealth management approach with differentialities from advisors who only manage investments. You guys help coordinate each of your clients' entire financial life, which is really cool, and we'll get into that. Include working with their advisors, so you can work if somebody already has an existing CPA attorney or something along those lines to help ensure their money's working for them efficiently, which is really important. You're in the industry, and we know in that particular industry, you really got to be careful who you're working with, right?
It's true. And it's really important if you have a team of advisors to utilize them and get the most out of them that you can. And so if you have legal counsel and you have a CPA and tax person, they can work well with your financial planning partner and help you create a solid plan to deal with any of the many pitfalls that happen when you go through life. Awesome.
I'd like to start today with talking with the folks. I'm huge on mindset and your money, just because, I found through conversations, most people mindset with money is set so early in their life, literally as kids, because I've understand now that most people do not learn financial literacy from their parents. They end up a lot of mimicking of what parents can do. And this is good and bad, right? Because if your parents, for whatever reason, weren't doing great things with their money and you were mimicking, you pick up those habits. So my first question is going to be, what are some of the misbeliefs people have about hiring a wealth management professional such as yourself?
Well, there's a couple of common myths. One is that they're expensive. That would be an easy one, right? So, we don't work with people that we can't help. So when you interview somebody, you want to find out what they're going to do for you and what the value is that they bring to the table. So if they can clearly demonstrate that they're adding value to your life and your financial planning, then they're usually worth whatever the fee is they charge. We believe planning is so important that we discount our financial plan fees. And in fact, for clients where we manage a portfolio, we include that plan as part of the portfolio management fee, which is very rare in the business.
Okay. Again, for everybody that's out there in the beliefs that are out there. So when you talk about managing a portfolio, I want to just bring up a scenario of, let's say you got just Mr. and Mrs. Jones out there and they started to accumulate some money. We'll talk the dollar amount in a minute. At what point in time is the right time to contact someone like yourself? Is there a dollar amount they need or you would like to see them have before they contact you?
No. People should get started early. As you said, part of the whole thing is the mindset and the education. So if you can work with people at a young age and get the acumen down and learn about what you're trying to do over the course of your life, you're going to be way ahead. So a lot of money managers have a minimum investment size. If you do financial planning, typically you don't, because we're looking at somebody's holistic financial picture. We're trying to help them get where they need to be and achieve their goals. And it's not necessarily a matter of the size of the portfolio at that time.
So you're going to work with people. They're going to come in. Obviously, you have a fee to do that. What can someone expect? Again, let's say you've got a young family. Let's say you're a 25-year-old couple, no kids yet. They're both working full time. Maybe they're each making $50,000 a year. Is that about the right time they should come see you, or do you think someone could come and talk to you before college?
No, well, that's a great time. It's kind of whenever you're motivated and willing to spend the time, right? Typically if you're in college, you're kind of just trying to get through college. You're not worried so much about what's going to happen with your long-term goals. You're trying to just get to that point. But then certainly when you get your first major career job, that's a good time to talk about all this, because you're faced with decisions about how to fund your retirement plans, what types of benefits you take. If you're married, how do you handle your taxes, and all of these questions that come up. So we often work with clients that are older, and they have us help their children and grandchildren. So it's kind of a package approach, and we can fill in the blanks and help them with some of the education that they maybe missed along the way.
So back to where, people are, their belief systems, right? And again, I find that people's belief systems are so strong, and it's hard to break that chain, so to speak, that they believe that I can't go see you, I don't have no money, right? How do we break that barrier when we're like, you need to go see a wealth management expert just like you need to go see your dentist? You know what I mean? You got to go see, hey, my teeth are great. I just got to go in there and get a cleaning. I don't have any problems, right? But I got to go see them. So let's explain to them out there. So I want them to feel really comfortable about, hey, man, I got to call one. I got to call Kelly here. I need to sit with them and figure this thing out. I'm not making a whole lot of money, but that doesn't mean I shouldn't know where I'm going, right?
Absolutely. And I think if you have that sort of thirst for knowledge, and you say, hey, I can take this approach and go talk to someone, then you can learn something and kind of get the process started. The real deal is that most advisors aren't going to charge somebody for an initial consultation, right? Just like an attorney. If we're going to get into doing some work or, creating something, then maybe there'd be some cost to that. But typically you can interview a couple of financial planning people, and it's not going to cost you anything. And as you do that, hopefully they'll tell you, what kind of questions to ask. And that's really important.
What can someone expect as far as, okay, you did your first, you're interviewing these, financial advisors, and what are some of the things that they should be looking for to make sure they're the person they're talking to? Because this is someone you've got to really learn how to trust, because you're trusting not just a fee you may be paying right now, but you're trusting someone on the next 20, 30, 40 years of your life with the navigating of your retirement or your funds and your portfolio. What are some of the things that people should look out for? Because in any and all industries, we have the good, honest folks, and then we have the some that, hey, I'm just here to make some money. I really don't care about you in the long term.
Right. Good point. Well, to get started, sometimes you can get a referral to somebody through maybe your CPA or an attorney or another professional that you know. Ask them if they've worked with any financial planners, and ask them, what they've experienced and what who they would recommend talking to. Then when you get an appointment and you meet with somebody, you want to look at their credentials, find out what their education is, their background, find out what licenses they hold, Ask them questions about how they charge, what their fees are, how they make their money. Ask them about what kind of conflicts of interest they might have, because everybody's got some biases or conflicts of interest that may be impacting their business relationships. So explore that with them. And then, find out who their typical clients are, right? Because people specialize sometimes. And if you're in a certain industry or certain station in life, as you said, if you're, first career job, there are planners that work with those kind of people regularly, and those would be the ones you'd want to talk to.
Is the fees that the same across the board, or they really vary a lot?
Absolutely not. There's no standard fee. It's we base our fees on the notion of an hourly charge. But because I've been doing this so long, I can estimate how much time it'll take, and I quote somebody a fee that they know what they're going to pay. We know how long it's going to take to do the work. We know how many meetings we're going to have and what the end result is. So I can be very clear about what that cost is. Other people may charge an hourly fee, and so you kind of have an open-ended arrangement. And then a lot of people might charge a set fee that's based on some metric that they have.
So, and again, I just want the listeners to understand, obviously everybody, we all know if I got to pay something, but they're in their heads out there, and I've talked to them, they don't know, man, is this going to cost me $200 a year? Is this going to cost me $2,000 a year? Can we give them kind of I want them to be able to grasp so I don't want them to have the fear of going over there because, man, this thing could be $5,000. I don't have $5,000, or man, that $5,000 is 60% of the money I have right now. And just to put me on a path, that's why they feel they're not ready, right? They feel like I don't have enough money to invest to talk to somebody to help me put me on the right track. So what kind of dollars can we expect across? Just give me an average, and if you want to give me your fees, that's fine. But
it's hard to say because it depends on what kind of plan and how complex it is and what the moving parts are. But you can there are some planners that'll do a pretty good plan for maybe $500 or $600, and if it's a really complex situation, it could be $2,000 or $3,000, $4,000, right? But normally, again, it's like, what are you going to get out of that? So if a planner can help you put some goals together, improve your investments, reduce your taxes, give you a clear picture of what your retirement will look like, that's super valuable. And it's probably well worth the $500 or $600 a year if you're going to do an annual update.
For sure, guys. I'm 100% agree with you there. And again, for the listeners that are out there, and man, I'm fortunate enough to have listeners in like 9 different countries, and money's the same everywhere. We may have different types of money, but don't be afraid to invest in yourself, to talk to a professional, depending, and we're all different. There is no one size fits all by any means whatsoever. You could be single, you could be married, you could make 40 grand a year, you can make 200 grand a year. Your money roadmap is going to be different than everybody's, but at least understanding. And again, I think a lot of the folks that are listening to me are folks that are just regular blue collar folks making a living. They're just, you and I both know they're not on the right path. And it's unfortunate that they don't realize that they're not on the right path until they start to hit that 50 whatever age, 60 years old, wondering like, man, I've been working hard my whole life. I've got a 401k. It's not where I thought of. It's not going to be enough. Man, what are some of the things I should have been doing? And the most valuable asset we all have is time. And unfortunately, if you're 50, you're never going to be 25 again, right? And so a professional is going to be able to show you how to sit down and navigate your whatever you're making at that current time. Is that about right?
That's true. And, the thing about time is that it's great for compounding returns and interest. So the younger you get started, the easier it is to let the time do the compounding instead of you having to put more money into the plan to make it work. But these issues are common to people in all kind of status in life when it comes to retirement, because the universal question is, do I have enough? Right? Do I have enough? Whether I retire at 55 or 65, whether I have $500,000 or $5 million, I still don't know whether I have enough unless I do the math. And that's the common thread to this.
Yeah, you're 100%, because guys, nobody on this planet knows their last day. That's one thing we don't know. right? And we obviously want that last day to be as further out as we can, especially when you have family, you got kids and grandkids. You want to live a long time. For me, I understand. For me, retirement is about income, not about how much money I can save, right? Retirement is about letting my money make money for me 24/7, 365, no matter what I'm doing. Not necessarily I need to save $X by the time I'm whatever age, right?
Well, the thing about retirement is exactly that. It's about income and expenses, your cash flow, we call it.
Mm-hmm.
So, if you master your cash flow by creating some worksheets so you firmly know what your expenses are and you know what the variables are, then you can get your head around retiring and having a certain amount of income to cover those. And that's the reality. You need to master your cash flow and have that figured out so you can retire comfortably.
Is there a standard time people should look at their plan? Is this something that they should look at twice a year, once a year?
So normally we'd say, once a year is a pretty good time. Sometimes it's easier to do this when things are changing, right? So if something changes, your job, your career, your marital status, you sell your business, something happens, then, okay, things are different. I really need to look at it now. So that's another kind of trigger for doing that.
So you talked a minute ago about taxes. I believe taxes, which most people are afraid of for whatever reason. I don't know why. Don't be afraid of the tax man. Learn how to play the tax game, right? Let's talk with people about taxes and maybe the top 3 things they should really understand about taxes and how understanding the tax code, depending on the tax bracket you're in, because this is critical, on the things you should and shouldn't do, right, to benefit you when the tax time comes around. What can you share with them?
So taxes are an inevitable part of financial planning, right? And we all pay taxes. We have a progressive tax system in the U.S. So we have a low bracket or a low tax rate for a low amount of income, say 10% in the beginning of our earned income. And then as you make more, it goes up. 18%, 22%, 32%. So when you, for example, are married, you have to put your incomes together, right? If you both make $50,000, the first $50,000 is taxed less than the second $50,000. It's a progressive tax system. So what you have to save and invest is taxed at the top of all that earned income. So you're paying the highest tax rates on your investment savings and earnings. So it's really important to know what that is. And most people that pay a state income tax and a federal tax are paying somewhere around 30% of their earnings in taxes. So in order to avoid that, you need to know what tools you have. You need to use IRAs or Roth IRAs. You need to use 401ks or 403bs or 457 plans. Whatever benefits you have through your employment are the best place to start for that, because you can save the money right out of your check and it goes right into the investment funds and it's tax deferred. That's the other part about taxes that's really important, is that when you have money in tax deferred vehicles, you're going to pay the tax when you pull it out. So that's normally at retirement. So you don't get tax-free income from those 401k plans unless it's a Roth. So every dollar you take out is taxed when you pull it out of the plan.
So talk to the people, because a lot of conversations I've had, they still, what you just described, they hear, but they don't understand it. They don't get it, what tax deferred truly means. Let's break it down in the simplest terms when we talk about that. And you described it. And again, this is what when I talk to folks and they're talking to a financial professional, where we say things so fast that it goes over the heads and they didn't really get it. So first, let's start off with tax deferred, how it gets there and how they should treat it. And let's start off with, if you've got, I'd like to use scenarios. If you've got an individual who makes, let's say, $1,500 a week, right? And they're doing their taxes, but now they want to put money into one of those vehicles, what they can expect, not just less money coming home for, their expenses, but what they can expect in the future. Because to them, tax deferred people get in pickles, and where do they go? They want to go to those accounts. So explain to them why that's generally not a good idea, but sometimes we get stuck in, I call it a pickle. It could be an emergency of some sorts.
Right. So there's a couple things there. When you set up a plan to save some money, it's always good to put some money in the bank or someplace very liquid so you can use it for emergencies. So you want to set a goal up to have an emergency fund of at least a couple of months of expenses, right? So you've got this account that you can just make a phone call and you can get the money. When you allocate money to the retirement plan, we'll talk about that. It's going to go into usually a tax deferred account. So in your example, if you're making $1,500 a week, then let's say you can save comfortably $100, and that goes into the retirement plan. Well, the $100 is really only $70 of your money and $30 of tax that you would have paid. So you're getting the benefit of a full $100 contribution, even though net it would have only been worth 70 to you. So you have the government's money in this account, and it's compounding and building up over your lifetime. And then you pay the tax when you pull it out, as I mentioned. So that's important. And you really don't want to tap these accounts early because there's a 10% federal penalty and usually a state penalty as well, depending on where you are. In California, it's 2.5%.
Right. So, and that adds up a lot. And again, I think for you guys out there, and I've talked to a lot of people about this, man, you really got to understand the difference between an emergency, like, if you've been saving for 5 or 10 years, that account's got, let's round numbers, $100,000, and you really want to buy some car or something. That's not an emergency, right? An emergency to me would be medical. Maybe an emergency would be you lost someone in the family. You don't have the money to pay for the funeral. I got to pull out $10K, right? If you pull out $10,000, that's going to cost you $1,000 plus another, probably going to cost you about $1,200 to pull out $10,000. Is that about right?
That's about right. And some of the plans have features that will allow you to make a hardship withdrawal. So it's important to know what those are. Some plans, 403Bs and 401Ks, allow loans. Sometimes you can borrow up to half of the account or $50,000, whichever is less. And that's something you pay back, and you're paying it back out of your paycheck. So it's automatic and you make the interest. Usually you're paying yourself the interest. So looking at those kind of features and plans will allow you to avoid, spending money and paying the tax at the wrong time.
Is there any other penalties other than taking that stuff out early, state and federal?
So you pay ordinary income tax. So it's really difficult. If you can imagine, you're making, let's say you're making, in your example there, something like $70,000 a year, and then you pull out $10,000 out of your plan. Now you have $80,000 of taxable income, right? And if you had left it in the plan and you retired and you only have Social Security, then you're only going to be paying tax at the lower rate on that money as you pull it out. So it can be devastating if you're spending that money, and it's really hard to put it back in. Very few people take money out of a retirement plan and then get it back in there. That
is interesting how, hold on here. When you describe that a lot of people, for me, when I talk to them, don't understand when they take that money out, it is income when you do your taxes, right? They forget that. And you can't forget that just because you just really put yourself in another tax bracket, and then you could get yourself in a pickle financially, and you're like, well, wait a minute, what's going on here? I didn't know. And that's why educating is so important. I kind of lost my video here.
The retirement plan will send a 1099-R, which is the tax form that you'll get January 31st after the year you take the withdrawals. So you will get a nasty little reminder that you need to include that in your tax bill.
Well, good to know that people, they need to know these things. Just because they Having trouble here for a minute. They when they get out there and they do those things, they figure it's my money. Why can't I take it?
Right, and there are caveats. Tax is one of them. It's good to know that the penalty-free age for IRAs is age 59 and a half. So different retirement plans have different ages. An IRA 59 and a half is considered the time when you can avoid the penalty.
Correct. This is why I'll be 59 and a half in about 3 months. I'm super excited. Typically, nobody wants to get older, right? But
that's a good one. That's a good one. And age 65 is Medicare, right? So
right.
When you go on Medicare, you get a break on your health insurance, which is really important too.
Right. So for a lot of you guys that are out there, and you're thinking, well, at 59 and a half, I'll just go get some money. I'll start taking it out. You don't want to do that either, depending on how long you've had it working, correct?
Absolutely. So one of the secrets to having a what I'll call successful retirement plan and making your money last is to master your cash flow. And if you're lucky enough to have a pension or you're taking Social Security, neither one of those is typically going to increase much over your retirement. So your personal savings is going to be your inflation hedge. It will be the money you can take out later. So typically people these days are living longer. Baby boomers are living longer, and they are the biggest creditors of any generation we've had so far. They have a lot of debt. So it's really important to take a look at this and try not to spend your inflation hedge early, because it'll impact your lifestyle when you get out into your 70s and 80s.
Let's kind of switch gears here for a minute. And that's all great information. I hope you guys really took some good notes there. And get into insurance. There's so many insurance vehicles that we can invest with, and not the right ones and not the wrong ones. Let's kind of educate them on that a little bit.
Okay, well, it's a pretty big topic. So, starting with a couple of common types of insurance right now. So life insurance can be purchased as a term insurance policy or some sort of permanent policy where it has an investment value. And you really only, in your younger years, it makes sense to buy term insurance because it's inexpensive and you're trying to cover normally your income for your family. So you can determine the amount of insurance you need. You can get a fixed rate and you have it for a period of years, say 20 years. If you're trying to keep insurance for your whole life, then it might make sense to buy a more permanent policy, which has a cash value and it can earn money. But again, this is life insurance that you're buying with after-tax dollars. So you really want to look at what your benefits are through your work or your self-employment options and maximize your tax deductions, and then also buy the insurance if you have enough free cash flow.
Exactly. And depending how much money you make, guys out there, be careful on the term insurance. Obviously, if you're young, it's next to nothing. You could pay $20 or $30 a month for a decent, coverage, but it's termed out in 20, 30 years. So the whole life insurance, being careful that, because it can be a little pricey even at the younger age, because you're doing two things. You're covering your death benefit and you're investing at the same time, right? And so you're a little bit commingling. How are you on that? Which one do you prefer?
Well, it kind of depends on the need. Again, so if I'll give you a good example. So I was talking to some clients this morning, and he's works for he's a fireman, so he's got a pension, right? And when you retire with the pension, you have to choose whether you keep that pension for your spouse if you die or not, and you get more money if you don't have any benefit for your spouse or a reduced benefit. But if you want to buy life insurance, you would need to buy a permanent life insurance policy so that it lasts as long as you do, and that benefit goes to your spouse, and you can pay for it with the increased money from the pension.
So again, unless you have some of these state jobs, there really aren't hardly any more companies out there offering pensions.
No, pensions are pretty much gone right now. Teachers, public service, government employees, and unions.
Mm-hmm.
That's it.
That's it.
But it's interesting when when Social Security first started, it was only meant to be a third of our retirement savings. It was supposed to be a third at Social Security, a third at the pension, and a third with your own savings. And unfortunately, now with people not saving enough, they end up trying to live on Social Security, and it's just not really possible.
It's not possible. I'm really glad that you brought that up, because people believe their 401k is their retirement, and it was only meant to be one leg of the three-legged stool, right?
Correct.
And
Correct.
so I want you guys to truly, listen to that again. The 401k was never intended to be your retirement. It was just one leg of a three-legged stool. I can't stress that enough. I have seen hundreds and hundreds of 401k plans, and then all the ones that I've seen, I've literally only seen 2 that had $1 million or more in it, right? Most people have not even 6 figures.
Right, and that's a shame. You really want to maximize that 401k contribution, but you also need to save some money outside of that. And then it depends on whether you have a pension or not. Some pensions replace Social Security, so you don't get Social Security. For example, if you're a teacher in California, you're going to collect the state teacher's retirement pension, but you're not likely to get much, if anything, out of Social Security.
Right. Right. Those are some of the big things that when I talk to people, they don't understand. Again, that's one belief, 401k. Oh, I have a retirement plan. I have a 401k. I'm like, yeah, no. That's one piece of the puzzle here. What else are you doing? Well, that's all I have. Well, that and Social Security, they figure. Right. And then when you ask them how much money they have in there, how old? No, not enough. Remember, retirement is all about income, not trying to save a certain amount as a nest egg. What else can other types of information can we share with the audience to best put them in a position to come see someone like yourself? Again, they're all scared to come see you.
Well, I'm not going to bite anyone, so they shouldn't be that afraid. But, what I would say is that when you're thinking about retirement, it's really important to have this plan to master your cash flow, know where you are with your expenses, and then dream about what you want it to look like. A successful retirement is really about fun, family, and community, right? What are you going to do? Are you going to volunteer? Are you going to be more active in your church? Are you going to help raise your grandchildren? Are you going to travel? I mean, what do you want to do? So when you figure that out, you'll have a definition of what's meaningful and purposeful in your retirement years. And then you come back into what that costs, right? And that's the first thing to do, is kind of get your game plan going.
Well, and I also often talk to the millennials, the kids that are, say, 25 and younger, when they think, what am I worrying about retirement right now for? Why do I have to think about that? Why do I need to go see that person? I'm only 22 years old. And I share with them, I'm like, then you truly don't understand compounding, the rule of 72, because if you did, you'd understand this is exactly the time you need to be talking to somebody.
Right. Your money will double every 10 years if you earn 7.2% per year. So imagine you double from 25 to 35, and then you double again from 35 to 45, and then you double yet again. You could double 3 or 4 times if you get started early.
If you're 45, you're only going to double a couple times. So that number better be large. So, well, listen, Kelly, I think we gave the audience a lot to chew on here, a lot to think about, and hopefully got them to understand that they need to talk to someone like yourself as quickly as we can, as possible, to get that talk going. Don't wait. So guys, if you liked what you heard today, do me a favor. If you're on YouTube, smash that like button and subscribe. If you're on the podcast, go down there, subscribe to the podcast. I'm going to have Kelly's information down below where you can contact him and maybe set a meeting and see what he can do to help you out. So until next Wednesday, 7 a.m., it's my next podcast coming out. I'll see you guys next week, and you guys take care. Hey, everybody. Hope you enjoyed that episode. Really enjoyed making all these episodes for you. Remember, we're just having conversations with people's journey with money, and the things they did right with it, the things that did wrong with it, and how did they really come about getting their mindset with money. So every episode's different. We all have a good takeaway from them. So do me a favor,
hit the like button, smash the like button, and subscribe to my channel, because every episode that I do is going to be different, as all our journeys are different. So you guys take care, and we'll talk to you next week.